Hi everybody, I would like to put out this video to clear up some confusion around the economics behind the Truebit token and how it works. I'm just doing this to clear up the confusion. I would prefer to remain anonymous, so do not worry about subscribing, do not follow, because I will not put out any more videos. Now, when it comes to Truebit, this is fundamentally unlike any other coin or any other token. It has a real economic incentive around actually using the token, whereas most cryptocurrencies don't. To that end, I want to explain how the Truebit flows through the system. This is going to be very important later on when we start discussing pricing and price targets. Because this is going to have a large impact on how those price targets are reached and how an equilibrium price is reached. In essence, what a Truebit token is used for is to pay the cost of running a program or a piece of code off of the Ethereum blockchain. So not on the blockchain, but off of the Ethereum blockchain. And then used to put the result, not the whole program, but just the result, the important part, onto the Ethereum blockchain, while that whole process is being trustless, as in it's verified, it's secure. It's a way of hiding all the work that you do, which could be a lot of work, and just seeing the results on the blockchain. What this does, of course, is it removes the work from the blockchain, which in theory should remove the gas costs of the overall platform. But I want to point out a few things here that make this really different. First and foremost is the mint feature that is built into the operating system. And by operating system, you'll see people abbreviate it OS. That's where people go to start running code and to start actually using the system for its intended purpose. While you're there, you can mint new Truebit. This isn't buying one off of an exchange. This isn't taking from the existing supply. It's minting a brand new one. If you mint one Truebit from the operating system, then you will be increasing the supply by one. And so in theory, what people will do is they will take their Truebit, the users, and they will put them into the system, which will go to the task givers. Task givers are then going to split the Truebit between the verifiers and the solvers, who are in essence responsible for the calculations and verifying. And I don't want to get too much into the technical details there, but those pieces of Truebit will then go towards Ethereum costs of the gas of putting the actual result on the Ethereum blockchain. And what's left over in terms of the Truebit tokens will get burned. That's the most important part. By burned, I mean removed. I mean supply, total supply is going to be -1 from what it was before. It's a token that is designed to be created from scratch and then used up, and then it ceases to exist. It's very important to understand as we start talking about the economic implications of that when it comes to pricing and speculation. There's a few other key things here to note. First, anyone that is a solver has to purchase a solver license from the Truebit company. You can't just plug in a computer and start solving. And the verifiers, I believe, are going to have to stake significant amounts of Ethereum, possibly Truebit, but I believe it's Ethereum, in order to be verifiers. You'll also notice that there is a burn function here. This burn function is meant as a sort of safeguard for the solvers and the verifiers who are staking Ethereum. In essence, you can always burn Truebit for 1/8 of what the mint price is. In theory, and we'll get to more of this later, no one should ever actually use that because the burn price will always be lower than the market price. Now, I want to point out one very, very, very important fact. You might be thinking, if I can mint brand new tokens, who's to say that the price will ever go up? And there's a few reasons why that's not the case. The most important is that the cost of minting a token is not in US dollar, it is in Ethereum. For example, I pulled up the operating system's Truebit token minting price back on the 5th, and that price was 0.000422 Ethereum, which at that time was $1.45. You can see it right there. I pulled it up again today on the 11th after Ethereum has had a nice little run. The current price of Ethereum is about 4,124. The Truebit OS mint price is still 0.000422 Ethereum, but because Ethereum's gone up in US dollars, that means the mint price is now $1.74. What that means is, as you can guess, the mint price is pegged to the price of Ethereum if you're looking at it in terms of US dollars. So all that needs to happen in order for the mint price to go up is for the price of Ethereum to go up. In essence, this indicates a peg of Truebit to Ethereum, but there's far more going on than just that, and we're going to dive into that in a little bit. But as I said before, whenever we're looking at pricing, it's very important to understand that there is the burn, right? There's this fundamental burn. And this is important to understand the burn, because if you are, let's say you are looking to buy new tokens and use them, you don't just have to buy them from the operating system, as we had looked at previously. You can also buy them from the markets. You can get them on Uniswap, you can get them on MXC, you can get them on a bunch of decentralized exchanges. They're available everywhere. And if we assume that whoever is planning to use these tokens is a rational actor, they're going to go and buy them wherever it's cheapest. That is almost always not going to be the Truebit operating system. But here's the interesting thing, is that as people are buying these tokens from these exchanges, they are then taking them and they are burning them. And the reason why that's a very important thing when it comes to the price has to do with how price discovery works with liquidity pools. When we talk about price, there's always two elements, right? There's the price that you can get from the market, from the liquidity pools over at Uniswap, and there's also the price that you can get from the operating system, straight from the source. The operating system's price is fairly convoluted. We'll get into that more in a little bit. But in order to understand the economics behind this, you have to understand how liquidity pool price discovery works. It's actually much more simple than most people think. If any of you have ever contributed to a liquidity pool, you know that unless it's a specialized one like Bancor or the new Uniswap version 3 for concentrated liquidity, in general, for liquidity pools, the ratio of the assets has to be equal. If you put in $500 worth of Truebit, you have to put in $500 worth of Ethereum. And the reason why you have to do that is because it is the ratio of the assets in the pool that determines the price. And that is very, 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 very important to understand, because as people are buying and selling from the liquidity pool, buying the asset from the liquidity pool removes whatever you buy from the pool and adds whatever you're selling to that same pool. And what that's going to do is that's going to change the balance. Now you have less of whatever you bought, more of whatever you sold inside of the pool, which means that the ratio of value between the two is going to change. And that change is the new price. And that's why buying will increase the cost of whatever it is you're trying to buy, because now there's less of it remaining in the pool, but also because whatever you're trying to put into the pool, whatever you're selling, there's more of that in the pool. So the ratio that's changing. And that's exactly what slippage is. That's why the larger the buy, the more slippage you get, as the more you put into the pool, the more the ratio changes. Also, for people that already have money in the pool, the owners of the liquidity pool, that's what causes impermanent loss. As the asset price of one of the items goes up, they get more of that item, or sorry, they get less of that item as the buyers are taking that out of the pool, so they have less of it. But that is what fundamentally determines the price. You know, the more of one side of the pool that's removed, the more expensive that side of the pool is relative to the other sides. For example, let's say that there's 10,000 Ethereum and 20 million Truebit tokens in a pool. That would imply an exchange rate or a price of 2,000 True for 1 Ethereum. And I'm actually going to flip it around because I prefer to look at it the other way, the way the OS looks at it, which is a price of 0.0005 Ethereum for 1 True. And that's for that, that's even actually much closer to the actual mint price, which is 0.0004. Now, let's say you were to go in and you were to buy some Truebit, and you've got a ton, you're a whale, okay? you want to exchange 3,000 of your Ethereum to buy 6,000 True. And you're not actually going to get 6,000 True, but we'll get into that in a little bit. After you do that, you're putting in 3,000 ETH and you're taking out 6,000 True. So while the pool started off, sorry, 6 million True. So while the pool started off with 10,000 Ethereum, now there's 13,000 Ethereum. The pool started off with 20 million True. Now there's only 14 million True because the buyer just took 6 million True out. The new exchange rate is 0.0009 Ethereum. That means the price of True went up a lot. It's an 86% increase in the price of True in terms of Ethereum. And once you understand that, then you can understand things such as, slippage and permanent loss and why it happens. But more importantly, you can understand arbitrage plays, as well as why front running works. And if you want to know what a rug pull is, just imagine that someone were to do this exact same transaction, 3,000 ETH for 6 million True, and then right before they did it, they pulled out half of this liquidity, so that instead of 10,000 Ethereum, they only have 5,000 Ethereum in the pool, and then they do this same trade. Instead of 20 million Truebit, there's only 10 million Truebit, and then they do the same trade. That would double the amount of change in price. And that's what a rug pull is. Front running bots will do something similar. They'll buy ahead of time, spike the price up, and then sell afterwards, or the inverse, depending on which direction the exchange is facing. But anyway, liquidity pool price discovery is very important to understand. And the reason why it's important to understand for this is because of the key takeaway being that whenever you remove something from a liquidity pool, it increases the value of whatever it is you're removing. The reason why this is extremely important is because of the fact that Truebit has a burn. As long as the Truebit protocol is used as intended, tokens will be burned. That's what they're there for. The tokens exist to be burned. They are not meant to be speculated on, at least not directly. And as an aside, by the way, that's done by design. After looking at what happened to Ripple, the devs of Truebit, they don't want a coin that has no inherent value other than what speculators give it, because then they have to worry about the SEC. They want a token that's literally used, that's designed for a use, not a token that's worth an amount, but a token that provides a service. And by providing a service, they're going to get around a lot of the SEC scrutiny that's probably coming down on a lot of other cryptocurrencies that's out there right now. So going back, let's say that rational users of Truebit, they can buy from the market, from these liquidity pools, or they can buy from the OS. If the liquidity pools are cheaper than the operating system, then they'll buy from the liquidity pool. And if they're buying from the liquidity pool, that means they're removing their tokens, removing Truebit from the liquidity pool, which means that the price of the tokens, of Truebit tokens in the liquidity pool, is going to be going up. And those tokens that they're removing are being burned. They're not being put into other pools. They're not being speculated on later. They're being burned, which means that these users of the protocol will always be going into the markets, if the markets are cheaper, dragging the tokens out and then burning them. And then they'll need more, so they grab more from the markets. And eventually what this will do is this will have the Truebit market price eventually approach or become equal to the mint price in the operating system, minus the cost of gas. And the cost of gas is obviously going to be relative based on the size of how many Truebit you're buying and selling. But what this should do is that as long as it's being used, it's going to decrease the number of Truebit in circulation, and we should have the Truebit market price equal or approximate or approach the operating system mint price. But what happens if it goes higher? And this is actually where a lot of the misinformation comes in. If the Truebit market price exceeds the operating system's mint price, then that creates what's called an arbitrage opportunity. And we saw this weekend before last when Truebit was brand new. There were bots, and what they were doing is the bots were buying the Truebit straight from the operating system for, let's say, 0.0002 Ethereum, and then they were selling them on the Uniswap liquidity pool for like 0.00025 Ethereum, and they were making riskless money. Some people took the actions of those bots and said that it's the devs using a control bot to implement a bonding curve. No, no, it was absolutely not the devs. It was just some smart traders that knew how to get money off of the operating system. It's really easy, by the way, but they were the first ones to find out. And they just had a bot that was selling Truebit on the markets and buying it in the operating system and making a profit. And it was fascinating, but there was never any downside protection from those bots. The bots and the arbitrage opportunity really only exists if the market price inside of the liquidity pools exceeds the operating mint price. Let's talk about the operating mint price. Let's talk about that. And let's talk about the market cap and some of the upside potential for Truebit. With a typical coin, the amount that your market cap can change is equal to the amount that the price changes times the supply. You know, if you've got a coin with a market cap of 20 billion and the price of the coin doubles, then the market cap also doubles and goes up to 40 billion. It's pretty straightforward, pretty simple, right? Nothing revolutionary. Truebit's not like that. Truebit's not like that. And the reason why is that, and allegedly, I haven't been able to confirm this actual ratio, but it's something along these lines. But allegedly, every time the OS mint price doubles, the supply will also double. Well, going back a bit, what causes the operating system mint price to increase? Well, every time somebody mints a new coin, it increases the price for the next coin to be minted. And that ratio is equal to however fast the supply is growing. So for instance, if someone goes to the OS right now and mints a number of coins equal to the total existing supply, then that would be a doubling of the supply, right? And that would mean that the final mint price after that in the operating system would be double what it is right now. So again, Truebit has a changing supply. It's not just the operating system mint price that changes, it's the supply that changes. And the supply, again, assuming a 1-to-1 ratio, which is not confirmed, but it is something along those lines, and you can verify that just by the shape of this graph being a straight line, is proof that it's something along those lines. It might not be 1-1, it might be like 0.8, it might be 0.5, it might be 2, but it's a linear curve as evidenced by the fact that this is a straight line. But in essence, the change of the Truebit supply is roughly equal to the change in price, perhaps even exactly equal to. If the Truebit supply goes up by 100%, that would mean the Truebit minting operating system price would go up by 100%. So therefore, we can calculate that the change in the market cap of Truebit would be equal to the change in the price squared. Again, if we've got change in the price as equal to the change in supply, then we just substitute this in for this in this equation, and we've got change in price squared, which, as we follow that to its conclusion, the change in price for Truebit is the square root of the change in the market cap. But remember, and this is the most important part, as we talked about earlier, this is all in Ethereum. This is all in Ethereum. These are not in US dollars. The US dollar equation, once we factor in the fact that all of these numbers that we're talking about here is in Ethereum, like the Truebit market cap in terms of Ethereum, once we put all of that together, we get that the change in price in US dollars for Truebit is equal to the square root of the change in the market cap in terms of Ethereum times 1 plus the change in the price of Ethereum in US dollars. This is a conservative estimate. And the reason why this is conservative is because I am assuming that no true tokens are burned. Obviously, as we've talked about before, that's not a safe assumption. But for the purposes of this analysis, I wanted to be on the more conservative side. If we were to hypothesize that the tokens are burned, in essence, what that would do is it would steepen this line, make it a little bit more, steep, but it wouldn't make it parabolic. It wouldn't make it start, in like a y equals x squared type graph. And again, the reason why we feel confident in this is that this is a straight line. It's going up. We've got a lot of nice price increase here, but it's not parabolic as most investments are over time, especially new ones where the market cap is growing rapidly. And the reason why is because it's the square root. You take the square root of y equals x squared, you get, y equals x. And that's what it's designed to do. But again, this is all in Ethereum. This is all in Ethereum. And that is so, so important. I'm also assuming, though, and this is probably another very important thing, is that I'm assuming that True is already trading at its equilibrium price. Because all of that, minting new tokens and price increase from minting new tokens, that only happens when the liquidity pool price, the market price, is at or above the price in the operating system. But right now, and I don't know if this is going to be true for much longer, but right now, Truebit is actually only at 1/2 of its equilibrium price. And so if we actually factor in the fact that, that's the case, and if we assume that True is at 1/2 of its equilibrium price at the time of you watching this, then the change in price as a percentage in US dollars is equal to the square root of the change in market cap in Ethereum times the change in Ethereum times 2. That's pretty girthy. This is pretty girthy. And again, as tokens are burned, and if we factor that in, that would steepen the line. It wouldn't make it parabolic, it would steepen the line. But you know what would make it parabolic? Is if other economic forces came into play. The main one that would make it parabolic is if Ethereum is parabolic. When we were looking at this, Ethereum was pretty flat over this time period, and even if it had some slight ups and downs, people hadn't realized that this token is pretty tied in tight to the price of Ethereum. If Ethereum is parabolic, then what this token would participate in is that parabolic growth, but even steeper and even more so because of this additional potential for growth. This, growth based on its market cap in Ethereum is, squelched a little bit, but it can still get parabolic returns. In addition to, just like 5x, 6x, whatever x returns. I'm just, making numbers up here, but you can get basically whatever Ethereum's returns are. Which would be parabolic, and then you would increase that by the square root of the change in the market cap, which would be a positive number, assuming it's being used and tokens are being burned. If True is at 1/2 of its equilibrium price, then you would basically be getting double whatever Ethereum gets as a return, so parabolic times 2, not parabolic squared, but parabolic times 2. And then you would still also, assuming it reaches equilibrium and assuming tokens are used, be getting the benefit from this portion of the equation right here as the market cap increases in terms of Ethereum. Speculation will add volatility, though, and I can't stress this enough. Not a lot of people actually understand this coin. But the cool thing about this, and the reason why I like it so much, is that all of this stuff is math. The biggest variable here is the price of Ethereum, and the second biggest variable is going to be the usage rate of Truebit, which therein, you can get the burn rate from Truebit from the usage rate, but everything else is just economics and finance. So it's going to be an interesting token, and I think it'll be really interesting to watch some of the plays that emerge from how this token is used once investors and speculators realize the implications of its model, of its tokenomics. I think there are a lot of people right now that are very bearish on this token because they think there's a price ceiling. But the price ceiling is not that. It's not at all what people think it is. It's rather something that's meant to not outpace Ethereum by too much, but it's still outpacing Ethereum. And even then, we're only at 1/2 of the equilibrium price. So if you believe in Ethereum, it makes sense that let me rephrase that. If you believe in Ethereum and you believe that this token will be used, then it makes sense to invest in this. But this is not financial advice, because I'm not saying whether you should or shouldn't believe in Ethereum. There's a lot of volatility there, and estimating a price target for that is well beyond the scope of this video. But yeah, it's crazy the potential this thing has right now, just based on the economics of it. Speaking of potential, I want to talk one more time about the Truebit company and their incentives, because I think this is more than anything, the biggest endorsement of the coin or of the token that I've ever seen from any devs. The Truebit company does not have any Truebit of their own. They don't. You think about the typical ICO model. You think about a company that they pump up this coin, they keep a bunch of it for themselves, and their income, their profit is based off of increasing the value of their coin that they already are holding onto a bunch of. Truebit's not like that. They're not trying to see revenue growth from capital gains. They're not trying to make money from the capital gains of their token. Instead, they're trying to make gains from and make money from minting new tokens. The best way to make sure that they're the ones minting new tokens. Oh, and so let me back up a little bit. They are making their money from minting new tokens. They get paid in Ethereum. So if Ethereum goes up, they do get more money, although I'm assuming some of that's hedged in US dollars and used to pay the staff. But they aren't just holding on to an asset. They're getting new money coming in, on a daily or weekly or whatever basis. That's what they want. They want people to be minting new Truebit tokens, as much as possible. The more tokens that are minted, the more money that Truebit makes. And it's an ongoing thing. It's not where they're just holding on to the asset. They want people to keep using it. And it's not just minting for speculators either. In order for people to go back and actually go to the mint, we need the liquidity pool market price to be equal to the mint price, right? And that's why they have this burn mechanic. We've already talked about that, how when the tokens are burned, that over time will force the market price and the liquidity pools to reach or approximate the mint price. The fact that Truebit won't make another penny until the liquidity pool price is equal to the mint price. I mean, think about devs that would risk that. Using the coins, which would lead to a burn, forces that to happen. The market could also do that on its own if more speculators move into the space. But think about devs that would base their income not on the value of the token appreciating, but on the token getting used. And yes, obviously the market price can increase and people can still mint that way, like the arbitrage bots we talked about earlier. But in general, if this token is used, eventually they will have burned up every free floating Truebit that's out there, and they'll be forced to start minting new ones, which means Truebit will start getting new money. How much of a bullish statement is that from the devs to receive money in that way? It's fascinating to me. It's such a unique play, and I think it's going to be really beneficial for them in the long run. And again, this is all from the Truebit company. So overall, I think it's a very fascinating token, and I think a lot of the elements and aspects to it are misunderstood. This is really a token in the sense that you put it in and you get something for it. And that doesn't mean the economics are bad, it just means the economics are different. And right now, I think the economics are very, very fascinating. In any case, I hope you liked the video. If you didn't like it, go fuck yourself, and you suck. But for everyone else, yeah, just anytime somebody says something stupid, please correct them, because the wrong information from people that are bullish on Truebit is just as detrimental as wrong information from people who are bearish on Truebit. Just trying to set the record straight. Anyway, adios.